Okay, class, so this is the requirement 2 for problem 4-40, and I split it up so the video wasn't too long. And this one is actually interesting because it takes into account these two new accounts that we established and created when we did problem number 29, the video before the problem number 40. And those two accounts that we have are the estimated refund liability and the estimated inventory returns. And now we're looking at it from the seller point of view. So when we make a sale, we're still using the net method. So we're going to be taking the discount out up front, but we have to account for several things. One is when we make a sale, we have two journal entries, one for the sales part of it, one for the cost of goods sold part of it. And the other is going to be that we're going to use these estimated accounts. So there's several things going on here. So let's just get into it. And now we're looking at it from the concept of DM Furniture Warehouse. And the same journal entries, the same transactions will be retro furnishings, not finishings, purchase $7,200 of merchandise from DM Furniture Warehouse on account, terms 315 net 30 FOB shipping point. The goods cost DM Furniture Warehouse $4,300. Okay, so as we mentioned, when you're the seller and you make a sale, you actually have two accounts or two transactions that you have to put journal entries for. The first one is the sales part of the transaction. So we're going to debit accounts receivable. We're going to credit the sales revenue. And we already did this calculation. That's for $69.84. And the calculation is again 97% of 7,200. So 69.84, and that'll be the first part or the first journal entry when you make a sale. And then of course the second part has to do with this goods cost or cost of goods sold of 4,300. And that journal entry will be debiting cost of goods sold. It's the only expense, cost of goods sold is an expense. It's the only expense that you'll encounter that doesn't say expense. Okay, cost of goods sold is what it cost the seller to purchase the merchandise. And we're going to credit inventory because when we sell something, the amount of inventory we have goes down. And that's simply going to be that we were given this amount. And so that's going to be for 4,300. And 4,300. Now you do have several problems that they give you the percentage of the cost of goods sold. So you would multiply that percentage times, in this case, 7,200. But here they just give you the $4,300 cost of goods sold. Okay, now when the retro furnishings return 1,500 of the merchandise that was purchased, because we are the DM Furniture Warehouse, we have to record this return. And this is where those new accounts come in. And we're going to debit the estimated refund liability. Okay, because in problem 29, we established the total amount of refunds that we would have in the month. And now each time an individual customer returns something, we debit it. And it's like filling up a bucket and then emptying it out one cup at a time. So each time a customer returns an item, you have to debit the liability to lower it. And then of course, at the end of the next month, you would refill the bucket up. Okay, and of course, we're going to then credit accounts receivable, and this will be for 1455, and we did that calculation in the previous requirement 1, and so we're going to check our work. It says nice work. So that's when we make the sale. Now, the journal entry, and that's this is the return of the sale. And so the next journal entry is now the inventory portion of the merchandise return. So just as we had these 2 journal entries when we made a sale, we have to have 2 journal entries for the return. And the first one was the sales part of it, and that's where the estimated refund liability comes in. And now the second one has to do with the cost of goods sold, where we're going to debit inventory because we have more inventory. And we're going to have an estimated inventory return that we credit because this is an asset, a current asset, and it tells us the amount is for $900. So again, they give you the amount. But what's different here is using these 2 new accounts. One is a current liability and the other is a current asset. Check our answer. Well done. Now, when Retro Furnishings paid us the $3,400, we received, obviously, when something is paid, we receive cash, and the accounts receivable goes down. And again, because I did these calculations in the previous requirement, I'm not going to show you the calculations. I assume you know that 3,400 times 97% is 3,298. Okay, so that's the partial payment. And then, of course, the remaining amount is paid on July 31st. And so that journal entry is going to be, we're going to debit cash because we're collecting the cash. And again, we did this calculation and it's for $2,300. And then just as we debited inventory when we were the purchaser, now we're going to credit the sales revenue, okay? Because we actually have more sales revenue because the customer didn't take advantage of the discount, so we made more money off the sale than if they would have paid for the discount. And that makes sense. If you think about it in your own life, if you take a 10% discount, you only pay 90% of the sales price. If you miss out on that discount, you pay 100%. Okay, and then the accounts receivable is just the mirror image of the account payable when we were the purchaser, but now we're the seller. So it's going to be the 2231, which if we go back and we look at the 3 accounts receivable, we'll be able to calculate that without looking at the previous requirement. Okay, so class, that's just a real quick video to show you the sales side of the merchandiser using the net method. And I hope if you put the 2 together and you go over them several times, that this will help you when you take the midterm and when you do your student learning outcomes. Okay, bye for now.